Good morning, ladies and gentlemen, and welcome to the show on this Monday, the 3rd of January, 2022. When's the market's going to drop? Probably what you're all wondering. The Fed's out there and they're cutting, and they're going to continue to cut until things drop. They're going to cut deeper and deeper and deeper. They're not putting any money back in now. They're going to be hauling money out, and they're going to keep hauling money out until this thing breaks. And so when's it going to break? When do I think it's going to break? We're going to find out in this show. Let's get started. Let's open up the charts right here and take a look at what's going on. You know what? First big smash of the new year. Happy New Year, everybody. Happy New Year. Here's your big smash. They really smacked silver down. It's still down 37 cents. Bounced back a little bit, though. That was a big smack this morning, What can I say? When this thing turns around, it's going to turn around really big. They've really overcooked it, to tell you the truth, considering the way everything else has went up, and real contrarian investment at this point in time. But we're not going to stick on this a long time this morning. It's at 22.86 right now. It's down 44 cents. We're going to check gold. Gold today is down $27.80. You can see this is a big smackdown. Now, cryptocurrencies, they've been stalled here for a period of time and haven't been moving much. They've been stuck in around $2.25 trillion. It's 2249 right now. Let me refresh the page. 2248, so it's not moving much at all. It's really almost stalled and stopped. Let's take a look at Bitcoin price. It's $46,924 this morning. Let's take a look at the markets today, and we see they're still up. It's up 68 points on the day, 36,406. When is this going to really start to turn over? Well, we're getting there. We're going to talk about that just a little bit on this show. So Dow is up today. It's up 68 points, 36,406. Let's take a look now at crude oil. It's 75.59, and it's up 38 cents on the day so far. So, everything else is moving up. But, there's an enormous problem out there. The Fed's not going to be able to get away with what they're trying to do. This is a three-legged table. And they've decided they're going to pull one of the legs out from underneath the table. And they're going to keep going, too. They're not going to stop. They're going to keep going until the table starts to topple over. I know it's silly. It's really a silly game everybody's playing out here right now. But tell me what isn't, Okay, let's move on and take a look here at the MOVE Index today. 7710. We've been through an awful lot of silliness in the past couple of years, I'm going to tell you. I think we're going to catch a break. We're going to catch a break this spring, But it's going to lead to something. And I'm going to be getting into that. What it's going to lead to, this break we're going to catch this summer and probably a good chunk of this year. We've been through tremendous amount of Fed support, central bank support of the economy. They've put the system awash with money right now, but that liquidity is drying up so fast. I've done shows on this. I've talked about how the world now is turned into a money sieve. You ever drain spaghetti in a sieve? The water you pour the water in one side and it runs out the other side as fast as you pour it in. That's what the economy's become for liquidity. It's become a sieve. It's like the more money they put in. There used to be a time when they'd put $1 in and they would get a certain amount of productivity out. And a certain amount of GDP. The GDP would go up from that dollar that they put in. Now, it's got to the point where they pour the dollars in, or liquidity in. It runs out as fast as they pour it in one side. It runs out the other side. And this is because malinvestment and corruption have invaded our system completely and made it toxic. We've got a toxic system. But removing the liquidity now to try to straighten the system out is not the answer. And that's what they're going to do. It's just going to make the system collapse. So how long will we got till that collapse? And things start to collapse, and then they have to come back in and fix the mess that they've created? Well, the bond market is what's going to tell us this. And that's what we're going to move into, and we're going to take a look at right now is this bond market. Now, I was talking about this the other day, and I told you guys the marker on the U.S. 10-year. Let's take a look at the 10-year here. We'll specifically go in and take a look at it. Today, it's up almost 10 basis points on one day. It's at 1.59. Now, when I was telling you guys this, it was in the 1.4 range. And I was telling you about this the other day. It was around 1.45, 1.46. Now it's at 1.59. And the marker I set for you guys was 1.75 on this US 10-year. Well, we've moved almost halfway there from where we were. And I didn't expect the move to be this quick, but it might go back down some again. But toward 1.75. I didn't expect the move to... This is a big move. This is today. We're looking at 10 basis points. Once it hits 1.75 and it crosses that boundary and starts to head toward 2. That's what we're watching for very specifically. Because once it crosses that boundary of 1.75, then we're in the territory where the markets can start to turn downwards. Now, I don't expect this to go up in a straight line. I wouldn't be a bit surprised if tomorrow it fell 5 basis points again, back down into the 155 range or something like that. That wouldn't surprise me a bit. And so that's going to delay how long it takes to get to 1.75. And this is why I said to you guys, I'm expecting this to creep up. Now, we've had a sudden move to the upside right now. But I'm expecting it to creep up over the next period, over the next number of weeks, past that 1.75 mark, and then to move up higher, start to head toward 2. That's when the markets are going to start to get really trembly out there. Because this is a much bigger marketplace than all of the other markets. This is bigger than the Dow Jones. This is bigger than the Russell. It's bigger than the SP 500. It's bigger than all. It's bigger than the markets. This moves the markets. This is the dog. The markets are the tail. See? And so we're watching this very carefully, and it is starting to make its move toward 1.75. Now, how much can the system take? The Fed wants to keep going with what they're doing. They're going to keep going past the 1.75. Even when the markets start to turn down, the Fed's going to continue cutting. They're going to ignore when the markets go down maybe 5%, 3 to 5%. They're going to ignore that. And they're going to keep right on with what they're doing. Right in there. Taking that third leg out from underneath that three-legged table. They're going to continue sawing on that leg and they're crazy. They're crazy. They must know that this is going to bring things down. And when things bring things down, it's going to continue to bring things down until they relent. This is the biggest game, and it's the most interesting thing to watch I've ever seen in my life. You know, if you're into financials, this is what the Fed's doing right now. It's so ridiculous I have to laugh about it. I mean, they're gonna bring this thing down, and then when it bring it down at a certain point, they're gonna get scared. At a certain point, as it all starts to cascade down at a greater and ever greater speed and intensity, they're gonna get scared at a certain point. They will have created a crisis, And then they're the guys in there that has to fix the crisis. So, I mean, on the other side of this is the marker for gold and silver. When they fix that crisis that they create, when they knock this building down, the whole thing scares them, and then they come in and have to fix what they did with a patch-up job. And that always means more money creation. Then it's basically over. And we're going to see all these things like gold and silver break free at that point in time. That's when it's really going to break free. They're not going to be able to control the price anymore and price set it anymore. We're going to be off to the races toward our hyperinflation when that occurs. And it's not going to take long from now because they're knocking that leg out from underneath the table really quick. And we're seeing it starting here in the bond market, but this is just beginning. But this is one of those things where it's going to take 2 steps forward and take 1 step back. And so I fully expect that this is going to creep up. I don't expect it's going to go up suddenly, like really high, and this is going to be we're going to be suddenly into a crash. I don't think it's going to work that way. I think it's going to be something that is over the next number of months. As the Fed gets tighter and tighter, we're going to see these markets start to turn down. And so here it comes. So that's the marker, 1.75 on the U.S. 10-year Treasury. Let's move on and take a look here at the U.S. dollar index today, 96.29, and it's going up. Now, I'd expect the dollar would go up. And this kind of liquidity, artificial liquidity crunch that they're going to create. They're creating it. They're doing it. They're out there, and I mean, what are they really trying to do anyway? Balance the budget? I mean, this is too much for it to just to be them being not smart enough to know what they're doing. They know that they're going to turn everything downwards. But, I mean, it's kind of required of them at the same time because of inflation that they go into this kind of a tightening approach where they're going to try to quell inflation fears. And they are really frightened of inflation too. They're frightened of deflation, but they're frightened of inflation even more, the Fed is. You say, well, Glenn, why are they frightened of inflation? It's very simple. They have the tools to fight deflation. They can stop deflation anytime they want to. They can create as much money as they want. Just look at if you were the Fed and you got unlimited resources to create as much money as you want. Deflation's not a problem. They can kill it. They have the machinery to stop deflation. So that's where they're heading right now. They're heading toward that safe harbor of deflation that they can control. They're basically buying time from this inflation. They fear inflation more because they do not have the tools to really fight inflation. They can't raise interest rates any longer to bring high enough because they have to raise interest rates higher than the amount of inflation. And so, in other words, if right now the CPI print is over 6%, and the real rate of inflation is probably up around 15% or higher than 10% anyway. Let's say higher than 10%. Well, that means they'd have to get those bond yields up well in excess of that in order to curb inflation at this point. That means that they'd have to have a bond yield of 15% on the U.S. 10-year. And we're looking at a peasily little 1.5. That ain't going to kill inflation. And they're talking about raising it 25 basis points to a time, the yields on Treasury yields. On the overnight rate and the federal funds rate and stuff at a certain point this summer. That ain't going to quell it. They're frightened of inflation. But what they are going to do is they're going to make all these markets fall out of bed. Because they require now a tremendous amount of support. It's an artificial system we got running here. It's not running on free market fundamentals and pricing set by the market. It's totally artificial. It's totally runs on central bank support. which they're withdrawing. But they are going to buy us a bit of time by doing what they're doing, by creating this correction, not a correction actually, it could even actually turn into a crash, and then coming in and repairing it. They're actually buying us a bit of time from the hyperinflation. They're probably extending it out a little bit further. My initial thoughts were, it depends on how far they actually go with this. They could actually bring the hyperinflation quicker. If they let this drop too far, in other words, if they let the markets drop too far, too precipitously fast, when the market drop does come, then that could spur the hyperinflation in quicker. But if they're able to pull this off, where they drop the markets just a little bit, cool down the inflation just a little bit, and then come in back in and support it, then they might be able to buy us some time. They're playing an awful dangerous game here, though. My thinking on this is that they should have just stayed the course. That's what I've been thinking. Is they should have just stayed the course and kept up with their stimulus programs and stuff, and not created this dipsy doodle in the economy that they're creating by being tight and trying to tighten. But we'll see how it all plays out in the end. It's going to play out really fast. It's going to play out in the next 90 days or so. This whole thing's going to play out. You know, they're not going to get very far. I think they'll get past their first cut, and I think it's going to be in the second cut of their quantitative easing program, when they cut back on quantitative easing, which they call tapering. I think it's going to be the second cut in their tapering, is when we're going to see the U.S. 10-year breach 1.75%. Let's take a look at it again. It's 1.59 right now. I think that's when we're going to see it breach that, and that's when we got to look for the real problems to set in. Thank you guys for listening. Like and subscribe. Remember, to be a contrarian right now might be a good thing, you know, and we're talking about gold and silver. To have a contrarian viewpoint. When everybody else is buying into all of this other stuff that's been going up and up and up, and you're buying into something that's been going down and down and down, and it's unloved right now, you know, might not have that much big a window of time left before the gold and silver start to really take off. Thank you guys for listening, and we'll catch you guys in the very next show. Bye-bye.